Hello, everyone. Welcome. I'm going to let people filter in from the waiting room for just a minute.
Got a good one today, I think, more.
I think so. I think it's going to be a good one. People still coming in here. We'll give it just another couple seconds. There's a waiting moment for everyone to come in from the waiting room. All right. I think we will get started, Yusuf.
Wonderful. And welcome to today's webinar that we've titled Stormy Skies, Clear Strategy. We've got a full agenda for you today. Before we show it to you, however, disclosures as is required, because we'll be talking about performance amongst an array of other topics. And before we get into the agenda, Lauren, some housekeeping items.
Yeah, as usual, please, questions are welcome throughout. So at any point, if you have a question on something that one of us is sharing, feel free to type it into the chat or into the Q&A. We'll be monitoring those. If it fits with what we're talking about, we'll bring it up right then, and we will have space for questions at the end. So please feel free at any point to ask questions, and we will get to them.
Brilliant. So on the list for today, we'll be talking about the war in Iran, effects on oil prices, an update on the Magnificent Seven companies, and a brief discussion about artificial intelligence, because I don't think we're allowed to do webinars anymore without talking about AI. Private credit has been in the news. We have some content about that. And as per usual, we'll be talking about the Fed, interest rates, and what's going on, what we expect coming out of their meeting next week. Lauren's going to take us on a tour through some information about Section 530A accounts, also known as Trump accounts. And throughout, there will be room for questions. And with that, we'll dive in. So the war in Iran has dominated headlines over the past 7 weeks or so. We thought we would begin our conversation today just by reviewing a timeline of how we got here. The initial strike was on February 28th. The U.S. and Israel launched strikes targeting Iranian leadership and military infrastructure. Over the next several days, the conflict escalated back and forth between all three nations, and Lebanon got pulled into the fray as well. Um, the biggest maybe focus has been on the Strait of Hormuz, which is a body of water through which some 20% of the oil that the world uses flows by way of shipping container. The strait's been effectively closed for the better part of the last 7 weeks, and that's led to a shortage in supply of oil that has affected oil prices fairly significantly. We'll talk about that in just a moment. Um, the conflict has kind of de-escalated, if we can say that, although there's headlines to the effect of, additional ships being shot as recently as today. Um, President Trump announced a ceasefire a couple of weeks ago, and this week said that that ceasefire would continue indefinitely, although it's a bit tenuous with, again, there's still some activity occurring, even though there isn't supposed to be right now. So we'll see what happens. Where do things stand as of today? Honestly, the picture is pretty gray. It's not very clear. The hope is that fighting will stop as soon as possible and we can resume something that looks like normality going forward. But it's really anyone's guess. Negotiations need to resume, hope for peace, and certainly hope that this thing gets put in our rearview mirror as soon as possible. As it pertains to what we're monitoring as the war continues, I mean, oil is one of the most significant factors of production. Every country uses it. Most industries rely on it for some form of energy and doing what they do to provide goods and services for people. So, we've seen oil prices climb significantly. Before the war started, price per barrel of oil was somewhere in the 50s, got up to as high as 110, with speculation that the number could balloon much, much higher than that the longer the conflict continues. Right now, oil trading at around 94, $95 a barrel. And the most, common place that people notice this is in the price of gas. Gas prices national average right now around $4 a gallon, which hurts consumers. Everyone needs gas. Most people drive cars. So that affects everyone's personal bottom line. So again, given that folks are sensitive about this, we're monitoring it closely. Of course, it affects everything about the way the economy is performing. So this is a story we'll continue to monitor. We know we've sent communication out over the past many weeks just with updates about how the portfolio is performing. We're going to talk about that here in just a moment. But pause, Lauren. Any questions coming in that we need to address before we move forward?
Not yet. The only thought on my mind is every time I see that $4 national average gas, I think about all of us living in the San Francisco Bay Area who have
Hmm.
quite higher prices than that.
Now, you'd love to see $4, I would imagine.
Yeah.
Um, so on the topic of performance, this is a chart with three lines on it. The dark green line is the YeskeBuie portfolio of stocks, which year to date is up 10%. You can see that the portfolio reached its all-time high sometime in late February. And then here we are at the beginning of March. And as soon as the conflict began, portfolio really started to take a hit. And from its high point to its lowest point in late March, call that a 10% drawdown. We effectively wiped out all the gains that we had seen year to date to that point. And then April happened. And as things started to de-escalate in terms of the war, um, markets started to recover rather quickly. I mean, you can see the way that the values declined while it was fairly precipitous and fairly dramatic. The snapback has been that much more dramatic and that much quicker, and we're grateful for that. The other two lines that you're seeing on this chart, the blue one represents the all country ex-US index. In other words, international stock performance year to date. And this is through yesterday, by the way. The red line is the all country world index, which includes the US and all the other countries around the world. That is our benchmark. And so when we look at how our portfolio of stocks is performing, relative to the benchmark against which we measure performance, we're happy to report our portfolio is outperforming by nearly a full 4 percentage points year to date. That's in part due to the presence of international stocks in our portfolio, which are outperforming those domestically. Um, and we'll have more on that as we continue through our slides here. We're going to kind of break down the performance of each of the positions in our portfolio here on the next slide.
Yusuf, what I think is so interesting looking at those lines you were showing on the last chart,
Mm,
not saying this is the same world we're living in, but if we think back to COVID in early 2020,
mhm.
things fell off a cliff for a couple months and turned around and skyrocketed out. And it really can change so quickly. And so that's, maybe I'm ruining part of our end thoughts, but that's the reason that we focus on the long run and not making decisions
Yes.
on what may feel and realistically can be really scary in the short run.
No, not ruining anything. In fact, you can't say it often enough. Stay the course. Don't panic. No matter how grim things might look or feel in any given moment, markets have always climbed a wall of worry. And so we have to be disciplined even when it feels scary. Um, as it pertains to the way our portfolio has been performing, I mentioned that international stocks were outperforming US stocks. Nowhere is that truer than in developing markets around the world. So your emerging markets fund here at the top of the heap, year to date, that is not a typo, has returned 21.5%. Um, Fabulous. And always glad to see when, that part of the portfolio is performing well as we are any other part of the portfolio. But um, really significant outperformance, even relative to everything else. And it's been a nice year, a nice start to the year, I should say, in absolute terms, if we look at these numbers. Up next, both of the small company funds in the US. So small and small value, nearly identical returns at 13 and change. And then large companies outside the US, international large value and international large. There's your top five. You'll notice we have a heading here at the top of the chart indicating the respective weight that each investment takes is assigned rather in our portfolio. So emerging markets being one of the smaller positions at 7%, but U.S. small and U.S. small value being two of the largest positions in the portfolio. And so when they're doing well and outperforming a position like, for example, the S&P 500, you're going to see those types of investments pulling our portfolio's performance up and away from the benchmark because we tilt the portfolio in favor of small company stocks and value stocks, as you've heard us say so many times. So no bad performers on this chart. If you annualize the S&P 500's performance year to date, take it out, stretch it out over a year, it's pointed at 15, 16% for the year, which would be fabulous if we ended up realizing that kind of growth. Um, don't even pretend that it makes sense to annualize the performance of the emerging markets. It would look like plus 80 on the year. We don't make predictions, but I wouldn't expect that to come to pass. Regardless, this is how the portfolio has performed when we break it down by segment. And again, thus far, it's been a nice start to the year.
And Yusuf, we have a great question coming in. There's so
Please.
much in the headlines all the time,
Mm,
and we all have our own sources of news and where we're looking. And so the question is from Jim on when I look at the markets, which market is the best indicator of the direction day to day? We're looking at the Dow, the S&P, the Russell, the NASDAQ, other pieces. It's a really good question.
Yeah, so we'll parse the question a bit and not to nitpick, but the question is fabulous. Any of those indices might give you a sense of the direction. They're usually all positive or all negative to varying degrees on any given day, but it's the varying degrees part that matters. Magnitude matters. And so if the S&P is up, half a point, but the U.S. small fund in your portfolio is up 1.5 points. You won't see that necessarily. The news doesn't necessarily report on, the Russell 2000, which tracks small companies in the U.S. or other less famous indices. But any index may give you an indicator for what direction the portfolio is moving in. But if you log into your Schwab account, you can see the day by day movements of each investment. And then, of course, we always point our clients to the direction of their client private page. We update the performance there monthly. It's about as frequent as we can manage. And of course, if there are any questions about performance on any given day, by all means, never hesitate to call or email us. We can provide whatever information you need.
Yeah, and if you're someone who likes to use the stocks app on your phone, for example,
Hmm.
you can actually add the individual funds, mutual funds that are in your portfolio
Yes,
to your watch list and check those in the evening each day. Again, that's a day to day, not something to make decisions on or rely on, but would give you a
right.
sense of just what happened today in the actual funds that I'm invested in.
Yeah, stocks or the Yahoo Finance app, which is also free. And this is a standing offer for anyone who wants me to replicate the setup that I have on my phone, for anyone who wants to see all the stuff that we track. Happy to do so. Um, as we move forward, we're going to focus on a subset of the stock market that we've been talking about for some time now. We've got the Magnificent Seven companies, and if we rank them by market cap or the size of the company, um, they are listed as such. At the top, NVIDIA, almost $5 trillion. If you take all the available shares for trade, multiply it by the current share price, NVIDIA comes in at the top, followed by Alphabet. We have it listed here as Google because that's the term that most folks are most familiar with. At 4 trillion, Apple at 3.9 trillion, Microsoft 3.1 trillion, Amazon at 2.7, Meta at 1.7, Tesla at 1.2. Add them all together and it's some 20 trillion plus just across those seven companies. So how they move matters. And I will share, it's really annoying. When we prepared this chart earlier in the week, the YeskeBuie portfolio of stocks was at the top. Turns out Amazon has had a nice run the last couple of days. It's taken the lead spot. But when we look at how these companies have been performing this year, so many of them are playing a major role in the AI story, which is why we want to show you the performance. A number of them affected by AI AI related stories, I should say. We'll talk about Microsoft here in just a moment. Um, but the long and the short of it is most of these companies are doing well this year. Tesla having a rough go of it. They failed to meet expectations in Q1 in terms of total cars delivered. Um, and aside from Microsoft, the rest are in positive territory. Even Apple, with a change of CEO at the top there, Tim Cook stepping down after 15 years, John Ternus to replace him. Um, but let's talk about how these various companies affect the performance of the S&P 500. These seven on their own represent a third of the S&P 500, which is ridiculous. And together, their total is a number that's greater than the total market cap of the United Kingdom plus Canada plus Japan combined, which is, again, they're just outrageous figures. And yet they're doing well. So when they're doing well, they're going to pull the S&P 500 up with them, which is why you see, some of the biggest companies up here, better performance, and so they're dragging the rest of the index along with them. Microsoft, however, has had a really rough go of it. And we're focusing on Microsoft not because we have any beef with the company in particular, but because if you remember some of the headlines from earlier this year about the SaaS apocalypse or software as a service apocalypse, of the companies listed, Microsoft is the one with the most exposure to the software side of the tech industry. Um, and the idea being that some of the AI bots, your Claudes, your Chat GPTs, are better at coding and developing software than people are, which means, uh-oh, if a company makes its money by developing software, but Claude can do it better, faster, stronger, then what's to happen to a company like Microsoft? No one knows. But you can see that investors are starting to price that risk into the stock's price. And so we're seeing, so far year to date down 10%. It'll be interesting to see how Microsoft and other companies in that space pivot as we continue to learn more about how AI is going to change the world. Is AI a bubble? Still, nobody knows. But the discussion is changing a bit. I mean, articles I read this week were saying maybe not. We've talked a lot in webinars like this about how, if we look back to different technological revolutions, be it railroads or, the internet and fiber optic cable, infrastructure kind of outpaced demand, development of infrastructure outpaced demand. So in other words, supply was outpacing demand for that technology. Not what we're seeing right now. What we're seeing is the opposite. Demand for the use of AI technology is outstripping supply, which is encouraging for that part of the industry and means perhaps instead of railroads or fiber optic cable, the more appropriate analogy or historical analogy to look back at would be the advent of electricity. Also, technology that changed the world. And not to say that, the implementation of using electricity as a new technology was seamless. There were, fits and starts and, you know, other issues. However, just a different way of thinking about how the AI discussion is evolving. And as we learn more, we'll continue to share more in this space and in the digest, in our meetings and individual conversations with our clients. So more to come there. Keep the Microsoft idea in your mind, the software as a service and SaaS apocalypse piece, because it's a good segue into our next segment here, talking about private credit. Private credit also big in the headlines in the first quarter of 2026. Before we talk about some of, why the Microsoft story is relevant here, let's first define what exactly is private credit. So private credit or private debt investments are debt-like, non-publicly traded instruments provided by non-bank entities, such as private credit funds, business development companies, often called BDCs, and these debt instruments are used to fund private business. So private credit is typically extended to a middle market firm with annual revenues somewhere between 10 million and a billion. Companies that are on the rise need capital to continue to grow. But what does all that really mean? We use debt instruments in your portfolio in the form of bonds, right? And we'll talk about how those parts of the portfolio have been performing year to date. But the way that a private credit fund would differ from the bonds in your portfolio, we think of three critical ways. Number one, the debt in a private credit fund is of a higher risk level than the debt instruments that are in your bond fund. So, for example, if we take the 1 year fixed fund, which we use in most of our clients' portfolios, that's government debt, it's treasury bills, seen often as one of the safest investments out there. The 5 year global debt, 5 year global bond fund, a lot of the bonds in that portfolio and that mutual fund are corporate bonds, so loans that companies have taken out or issued. Um, these higher risk loans to these smaller companies come at a level of risk that we're simply not comfortable with for our clients. What makes them even less attractive for our clients are the fact that they're illiquid. And this was a lot of what the headlines were focusing on. Investors were trying to take money out of their private credit investments and were capped redemptions or how much money you could take out at any given moment. And usually redemptions are only allowed once per quarter with a private credit fund. We're capped at somewhere between 5 and 7%. So you could have put $100 in and wanted to take your $100 out and met with the answer that, oh no, you can only have $5 and then come see us in 3 months and maybe we'll give you $5 more. So the illiquidity really doesn't work for us. For those of our clients who are using their portfolio to support their spending needs, you know that we think of bonds as the stable reserve. Liquidity is a critical aspect of how we manage the portfolio for that specific need, and illiquid debt instruments just don't work for us. And then finally, another reason that the private credit funds are different from the bonds that we use for our clients is they're opaque. It's not always clear what the underlying loans, you know, which companies they're to, the size, the structure of those loans, and um, again, just not something that works for the way that we invest money on behalf of our clients. Um, the latest news, interestingly, so again, a number of the private credit funds that were having trouble earlier in the year were heavily invested in software companies. And so as the SaaS apocalypse was dominating the headlines, a lot of investors were saying, "Oh God, that's bad for my private credit fund. Give me my money." And they weren't able to get their money as fast as they wanted, which perpetuated the drama in that part of the market. Um, Since then, however, that's calmed down a bit. In fact, we've seen some headlines where other bond fund managers have actually picked up some of the debt that was unloaded by, for example, in the case that I'm about to mention, Blue Owl was big in the news and they had unloaded some 400 million in bonds to free up cash so they could meet the demands of their investors and fund those redemptions so investors could take their money out of the fund. PIMCO, one of the most well-renowned fund managers in the world in terms of bonds, just bought up all that debt. So they must think it's attractive for some reason. So it's just interesting to observe how the ebbs and flows of the market are playing out. A lot of private credit funds are still drawing in new investments. And the fears around the SaaS apocalypse have abated for now. Who's to say whether or not software as a service comes under fire again? As the AI technology continues to improve. But for now, it's not the biggest story. And we've seen actually, as we move to performance, a lot of these private credit funds have recovered considerably over the last 3 or 4 weeks. We'll focus on Blue Owl, still down 32% year to date, but that number was minus 45 just a couple of weeks ago. So some significant rebounding. Apollo, Blackstone, other names you may have seen in the headlines. KKR is another big private credit shop. They're down 17% year to date. Ares down 24. You can see some of the other numbers here. Um, the bonds that we use in the majority of our clients' portfolios are listed here at the top. DFA is 1 year fixed, Global Core Plus, and the 5 year Global Fund, all performing as expected this year. Stable, if not exciting returns, but on the positive side of the ledger and providing exactly what we expect them to in terms of the role that we want them to play in our client's portfolio. Stability, a bit of return, liquidity, and curbing the volatility of the overall portfolio.
And Yusuf, I think here it's what you just said is really important to point out. Even if these private credit funds were the opposite way,
Right.
35% up, we would still feel exactly the same way about not wanting to invest in them, about how our bonds function for us in the portfolio.
Yes, yes, we don't chase returns. Our objective is not to have the portfolio that beats everything out there all the time. Our objective is to have a portfolio that performs as it needs to support your financial planning goals. Those are two very different objectives. Finally, here, just rounding out my segment, talking about the Fed, interest rates. Been a lot of headlines about the Fed this week with the chair to be, we think, probably Kevin Warsh going through his confirmation hearing earlier this week. Um, Part of the uncertainty around Warsh's confirmation is the fact that Senator Tom Tillis has made it abundantly clear that he will not vote yes on Warsh's confirmation until the investigation that the DOJ has in place on current chair Jerome Powell as it pertains to the Fed building renovations. Senator Tillis has said he will not vote yes for Warsh until that investigation is dropped. So we're at a bit of an impasse here. I was reading an article this morning that was put out by CNN. We have the link handy and can share it with anybody who's interested about some of the options available if Majority Party Leader Tooney wants to push this through in a way that doesn't require a vote. But it's looking like we're going to be stuck here until or unless something changes. So more to come as we learn more. But this could mean that Chairman Powell may be in power for longer than the scheduled end of his term, which is next month. More to come there. As it pertains to the decisions the Fed makes around interest rates, as you all have heard us say before, the Fed has a dual mandate. They manage unemployment and price level or inflation. The labor market's still in a really healthy place, although perhaps seeing some softening. The unemployment rate ticking up marginally higher, job growth slowing a bit as of late, but still at 4.3%, which qualifies as full employment. And inflation ticked up a bit higher in the most recent reading. No surprises there, given the effects of tariffs over the past year. And then, of course, with the supply shock to oil prices going up, that's going to drive inflation up as well. We'll see how that story continues to play out. For now, you can see the various measures of inflation that the Fed pays attention to listed on the slide. Higher than they want, but not grossly so. And with that, the expectation is that the Fed is going to hold interest rates steady when they meet next week. Right now, the baseline interest rate and the federal funds rate hovering somewhere between 3.5% and 3.75%. The expectation is that will remain the case after they conclude their meeting next week. Now, if anything changes in the news that changes that story, you can perhaps expect to hear from us. But in the meantime, that's what things are looking like right now. Any questions, Lauren, before I wrap up my end of things?
Not at the moment.
Okay, so with that, we'll take you through one final slide. Again, not to be too cheeky here, but the title of our presentation today, Stormy Skies, talked about a lot of the things that could qualify as storms that the market has been dealing with. What's the strategy? We have a three-pronged message to share with you today. Number one, stay in the boat. Even as markets react to the latest news. As we've seen, values can drop quickly and it can recover even more rapidly. And you don't want to miss out. So keep calm, carry on. Keep your eye on the horizon. Maintain your perspective. We believe you'll get to where you're headed, even if the waters are a bit choppy en route. And finally, don't take your hands off the wheel. Stay engaged and control what you can control. Your financial plan is your ultimate source of resiliency as it pertains to your financial life, and financial planning process, as you've heard us say so many times, is ongoing. So lean on us. Make sure that you're staying on course, help you control the controllables. And with that, something that our clients can control, whether or not they participate in and take advantage of, would be the topic of conversation that you'll be leading us through, Lauren.
Yeah, and I'm going to give a second in case there are any questions
Mm,
anyone has on some of the market and economy pieces. Go ahead and type them into the Q&A or the chat now. Something, Yusuf, that I just have to say that's been running through my head since the first time you said SaaS apocalypse is that is what my home is every evening with a 2-year-old and a 4-year-old. And I couldn't stop thinking about it because, for as an example, my 4-year-old the other day said, "Good story, mom," but I wasn't listening and went back to
mm.
what she was doing. So it's not software as a service, it's just general sassiness that my parents warned me would come back to bite me one day, and they were right.
Well, the sass is in our house too. Our 5-year-old was asked recently if she had any love to give, any hugs to give, and she said that her love machine was off for the day and she had no further hugs to provide. So
There
like
you
that
go.
sometimes.
SaaS apocalypse. So no questions have come in, but please, if you have them, feel free to type them in. We'll circle back to them in a few minutes after talking about some Section 530A accounts. And so we can shift into that, Yusuf, if you want to click us through. So
Hmm.
Section 530A accounts, you probably have heard them referred to most commonly in the news as Trump accounts. They were created as part of the One Big Beautiful Bill Act, so the major tax law change that happened last year that has a lot of different phases and implementation pieces. And so this was something that was an idea in that bill that was put in and then was like, okay, well, the IRS will figure this out and we'll roll it out sometime later. So a lot of additional guidance has come out in the months since then, almost year since that tax law change came out. And as with all things with the IRS, there is still a lot to be clarified that may or may not be clarified in time or will be done retroactively. But really, these Section 530A accounts, they're called that because they are part of the Internal Revenue Code, Section 530A. So you may know about 529 accounts. Those are part of the code in Section 529. It's a special type of IRA for children under 18. So the intention is to save money for retirement, to jumpstart the American dream. One of the specific features of this specific IRA that is not true of other traditional IRAs is that there is no earned income requirement. So usually in order to contribute to an IRA or Roth IRA, you must have earned income. There are a couple other exceptions there if you don't have if spousal exceptions there, but in general, if a child has earned income, they can contribute to an IRA. Most children don't, although I think of Mary Kate and Ashley Olsen from my childhood. They were working from the time they were infants. So they had earned income at that point. They maybe had IRAs at that point. But there is no earned income requirement for these Section 530A accounts. Contributions can be made at any point. Um, there are kind of two important people for these accounts. There is the beneficiary, the person who eventually this money is for. That's the child. They must be under 18 at the end of the year in which you are opening or funding the account. They must be a US citizen and they must have a valid social security number. So those are the three requirements for an account to be opened in the child's name. And the second important person in the setup is the account owner. Most of the time, that's going to be one of the parents or one of the guardians of the child. It could also be a grandparent or an adult sibling, potentially. But most of the time, it's going to be a parent opening the account for the child. Um, Theoretically, these accounts are set to be kind of ready for action on July 4th of this year. Now, that's obviously an important date in the country, but it's also a Saturday. So realistically, probably Monday, July 6th, the next business day. Now, like I said, there's still a lot to be clarified. And so it's unclear whether the accounts will be open and ready for contributions that day, or if that's the deadline for more guidance from the IRS. So there are a couple ways that you can actually open or at this point have an application ready to open an account once they're available. The tax form to open an account is called Form 4547. You can file it with your tax return. So, for example, if you filed an extension and you file your tax return later this year, you can ask your tax professional to add 4547 in there to open an account or open multiple accounts if you have multiple children. You can also file that form standalone. And this is true for future years. Maybe you don't have a child yet, or you're not opening an account this year, but you want to do it with your tax return in 2027, 2028, any of the years that there is a child under 18, you can file it with your tax return. You can also open the account online. So you can go to trumpaccounts.gov. That's where you can do the same application process to put in the information for the account owner, the beneficiary, and when there is further guidance for these accounts where they will actually exist and the process to get them activated, you will get contacted at that point.
So before we move on, Laura, just if we're going to keep the Full House reference going, if I was opening up one of these for Michelle, I couldn't do it if I was Uncle Jesse, right? It has to be Dad who opens it up.
Correct.
Okay, just confirming. leave it to the San Franciscan to make a Full House reference.
So we'll talk a little bit about contributions. Contributions to these accounts are generally limited to $5,000 per year per account. So if I have an account open for my daughter and an account open for my son, I can give $5,000 a year to each of those accounts, but that is total. So if I give 4,000 and grandparents want to contribute, they can only give 1,000. The maximum is that 5,000, regardless of who is contributing, how many contributions come in, $5,000 per account. And you cannot have multiple accounts for the child. So like I could not open an account for my daughter and my husband open an account for my daughter. It's one per beneficiary, 5,000 maximum a year. And there are some nuances there. So one of the potential appealing pieces is that employers can contribute to these accounts for the benefit of their employees' children. So, YeskeBuie could contribute to this account for Yusuf's children up to $2,500 per year, and that is included in that $5,000 annual maximum. Federally, these contributions are not taxable to the employee owner of the account. So if we gave it for Yusuf's kids, that is not taxable to Yusuf. But it is deductible for the company. So there's an appeal there for companies to be able to support their employees and have a deduction. For those of us in California, you may know that California doesn't like to follow many tax rules. And so in California, it does appear actually that these employer contributions will be taxable income to the account owner. And so I would say that's a ding on the appeal of this aspect. But it is a feature that's available. One of the other features is that for any child born between January 1, 2025 and December 31st, 2028, there's $1,000 of seed money that the Treasury will be giving to accounts opened for those children. So a free $1,000 that is going to go into any account that is open for a child born between 2025 and 2028. And that $1,000, interestingly enough, is not included in that $5,000 maximum. And any future contributions by government entities, whether it's a federal or a state government or a charitable entity, if there are others who are offering contributions for the benefit of any children, those also don't count in that $5,000 annual limit. So I'll give you an example of that. While the U.S. Treasury is giving this $1,000 of seed money for any child born between 2025 and 2028, there are a couple organizations who are doing similar things for low-income zip codes in certain states. So there may be some zip codes that qualify in certain states where there is an additional seed fund available to give contributions to children who live in that zip code. If that's coming from a governmental or charitable entity, that does not count in that $5,000 a year maximum limit. And as we'll see in some of the next pieces here, there are some considerations there. That sounds really great, but there are future implications to that money. Whether you are the one contributing the money or a governmental entity is the one contributing the money, it will be treated differently when it is withdrawn later in the future. So if we look at distributions, nothing is allowed prior to 18, no distributions. The account is locked. There is no possible exception. The money cannot come out of that account once it is contributed for the beneficiary until they are 18. The year in which they turn 18, the account essentially converts to traditional IRA rules. And so there are penalties. If you take money out before retirement, there are exceptions to penalties. One of the things, I'm actually going to skip to my bottom bullet there was some early guidance that maybe there would be some kind of additional exceptions for money to start a small business. If this child, now adult, wanted to start a small business, there were some talks of having exceptions for the penalties starting at age 25, but that hasn't actually come to fruition at this point. As I said earlier, there still is a lot that remains to be clarified by the IRS on some of these accounts. So it's possible that comes back into play. So we're watching it. We'll keep updated on articles within the digest, future webinars, all of those pieces. But until it's finalized in the code and there is very clear direction from the IRS, we're not really sure exactly all the details yet. But one of the things that is pretty clear is how distributions will be taxable. So if you have an IRA or you know about IRA rules, really the intention for these accounts is to be used in retirement. And so if someone wants to take money out of an IRA prior to retirement, there are penalties. They want to dissuade you from doing so. So as with IRAs, any money that is considered pre-tax money in the account will be taxable at ordinary income tax rates when the money is withdrawn. In this case, there are two different buckets of money. Any money that family members are contributing to this account is what is called basis, which means it will not be treated as earnings. It will not be taxable when it is taken out. Any money that comes from a governmental or charitable entity or the earnings on what you have contributed and invested will all be taxable as ordinary income when it is withdrawn. And similar, exactly the same as IRAs, if you take, when this child, then adult, when they do this, takes the money out, those distributions are treated as pro rata. So I'll give you an example. I contribute $5,000 to the account for my daughter. By the time she takes the money out in the future, it's worth $10,000. So she has $5,000 of basis and $5,000 of earnings. If she takes out $100, $50 of it is tax-free basis, $50 is taxable earnings. And similar, same rules as IRAs. If any money comes out prior to age 59 and a half, in addition to ordinary income taxes on that earnings portion or the non-basis portion from government or charitable contributions, there are also penalties on that amount. So there is a 10% federal penalty on any distributions taken before age 59 and a half. And again, if you live in California, there is an additional 2.5% state penalty on top of that. So that's something to be really aware of. This is not money that this child can just willy-nilly take out at 18. There are consequences to doing so. Now, similar to IRAs, same exceptions. There are some exceptions to those penalties. Those earnings portions will always be taxable as ordinary income, but there are a few exceptions to the penalty where you can actually have the penalty waived. Some of those include first-time home purchase up to $10,000, costs for higher education, costs for care for a child with a disability, and a couple other pieces in there that qualify for those exceptions to the penalty. But again, it's really important to note, it is only the exception to the penalty. There will always be the taxes owed on that earnings portion.
Yeah, important distinction.
And so this is, I'm not going to read through these. This is just a summary kind of what I shared in the last two slides, but a helpful timeline. From birth to age 18, the account is locked. You can add money to it. You cannot take money out. And then those limits that we talked about. And that at age 18, it essentially shifts to traditional IRA rules where you're going to have some basis, some earnings, taxes and penalties on the earnings unless there is an exception. So as with all things IRS, there are always things remaining to be seen and things that are confusing when you try to read the IRS code and things that can certainly change. So right now, the things that still remain to be seen are the custodians. Who will actually hold these accounts? Will it be Schwab, where you have your current accounts? Will it be Fidelity? Will it be some other custodian where these accounts will actually exist and you will be able to see them and contribute to them and manage them? Same thing with the investment funds. What specific funds are going to be allowed? They have indicated that they will need to be index funds mostly invested in US stocks, but there are a lot of those out there. And so it remains to be seen, will it be the index funds for the custodian where the account is? And there's only one custodian. So all of this is to be determined or to be clarified by the IRS and guidance that they hopefully will provide before July 4th of this year. One of the interesting ones that I think is a potential ding on the appeal of these accounts when compared to other savings vehicles for children is whether or not these contributions will qualify as annual gifts. So right now there's a $19,000 annual gift limit. You can give $19,000 to any beneficiary before you have to report or file a gift tax return. And it's important to note that in most cases, even if you give more than $19,000, you don't all of a sudden owe gift tax. But you have to file the gift tax return because it has to be tracked because those reduce your estate tax exemption. Currently $15 million per person, a lot of space for gifting, but it does have to be tracked because any annual gifts to one person over 19,000 reduce that 15 million annual limit. And so if these contributions to these 530A accounts do not qualify within that $19,000 annual gift exclusion, that would mean that a gift tax return has to be filed every year you make a contribution. So if I have an account for my kids and I am making contributions every year, I'm going to have to file a gift tax return every year, and that will use up part of my lifetime exemption. And the same would be true if the grandparents and the aunts and uncles want to contribute to the account, they would also have to file a gift tax return. And so I think that's an administrative load that is not that appealing and could cause problems if people don't know that's a requirement or they're not following up
Right.
and doing it every year. So something that we're watching, and we'll see what the final guidance is. Similarly, who is going to track the basis and how? So the basis, if you recall, is what is not taxable at withdrawal. That is any of the family contributions. And with IRAs now, if you make a non-deductible contribution, you add basis to your IRA. You have to file Form 8606 with your tax return to track that. But you have to do it. The IRS is not the one saying, okay, we'll track this for you. The custodians are certainly not the ones saying we will track this for you. It is your responsibility. And if you want to take that money out of your IRA tax-free in the future, you better track the basis. Otherwise, the IRS is going to come back and say, you owe taxes on this, prove it. And so this is another piece of what I would say is the administrative or logistical lift that is not yet clarified, and it needs to be really clear before someone starts contributing so that they know how and where they need to track that basis. And my assumption is that most likely, like IRAs, it's going to fall on the account owners and the beneficiaries, but it needs to be clarified so everyone knows what the process is. And as I shared, state taxes. Right now, it's looking like California is the only offender, if you will, of these accounts not being treated the same way they are federally. So as I mentioned before, it does appear that those employer contributions will be taxable income to the account owner. And it also appears that the investment earnings in the account will be subject to the kiddie tax rules. So if your child has an investment account like a custodial account, as that money is invested and earning money, and in the form of interest, dividends, capital gains distributions, or realized gains from rebalancing the account, that's all considered unearned income. And any form of unearned income for a child under 18 is subject to the kiddie tax rules. And what that means is the first $1,350 of income is not taxable to that child at all. The second $1,350 of this unearned income is taxable at the child's marginal tax rate, which is likely very low, unless they're the Mary Kate and Ashley Olsens and probably make a lot of money in the film industry. And however, after that $2,700, every dollar of investment earnings above and beyond that is taxable at the parent's marginal tax rate. And the reason for this is that it's to dissuade people from shifting income to their children in sketchy ways to pay lower taxes. So you can't do it. There is a little bit that you get a benefit of the child's unearned income, and then it's taxable at the parent's marginal tax rates. And so realistically, this is not an issue for the first couple years, probably the first decent number of years that you are maybe making that maximum contribution to a Section 530A account. But over time, if you're contributing and it's growing, the investment income will rise above those amounts. And so there will be tax reporting to be done on these accounts every year for California residents, it appears. So this is, again, not going to go through every line here, but something to be aware of and something we'd love to have conversations with you about for your family, whether it's your children, grandchildren, or loved ones. There are multiple vehicles within which you can save for children. Section 530A accounts being the ones we just spoke about, 529s, which are specific to college planning. You can get the money out for other reasons, but there are taxes and penalties on the earnings in those as well. And then there also are these custodial accounts. So you might have heard them referred to as UGMAs or UTMAs. Those are of course acronyms for the name of the account within the actual IRS tax system. Those custodial accounts are, I would say, the least restrictive. There is no limit to how much can be put in any year. You have the annual gift limit, but again, if you wanted to put more in, you file the gift tax return. That's a gift to the child. They are subject to kiddie tax rules from day one. And so as that money is invested, that is going to be reported on tax returns. And at the point at which that unearned income for the child is over $2,700, additional amounts will be taxed at the parent's marginal rate. And there are no restrictions on the use of those funds either. So you can take money out as long as it is for the benefit of that actual child, the person for whom that account is meant in the future. You can use those funds. So it's not limited only to education or only to, the exceptions within the 530A accounts for home buying. Those can be used at any point. Similarly to the 530A accounts, when that child becomes an adult, that account becomes theirs. And so there is an awareness to that in using those accounts. So the custodial accounts, there is an age of majority in every state. Many states it's 18. I know California it's 21. Other states 21. And at that age, when you set up the account, you determine that age of majority. At that age, that account becomes the child's. They can do anything they want. Now, they would have to pay capital gains tax if they sell everything, take it out, and go buy a Ferrari, which seems to be a big fear sometimes of some children. They would have the capital gains tax to pay, so it's not that it's just money there, but there are no restrictions. And once it's theirs,
Right.
there's no parental oversight that is enforceable. So there are different options, and there are different pros and cons to each of them, different specific uses for each of them. And so, there is not a blanket answer of everybody should open a 530A account or nobody should open a 530A account. It's specific to your situation. So would love to talk more about it next time we chat, or if you have specific questions, feel free to email us after this or put them in the chat Q&A now. But more to come, as always, with new tax law changes and updates coming. I did write an article about this a couple weeks ago that I'm about to put in the chat, and we'll make sure we are updating this or new pieces as additional guidance comes out from the IRS. And so now we'll shift into questions. We don't have any currently. I'm checking in the Q&A in the chat. No, none currently. But if there's anything on anything we've covered today or something we didn't cover that's been on your mind, please feel free to shoot that into the chat or the Q&A right now. Yusuf, we did have one come in a while ago just about feedback for next time about talking about the PPI in addition to CPI. And so that's something that we can certainly include in the next webinar when we're talking about just what things look like at that point.
And there was a surprise, CPI, Consumer Price Index, PPI, Producers Price Index. There was a surprise on the high side in the most recent reading for that indicator. So absolutely great feedback. And we'll make sure to include that going forward because all of that influences prices.
And we have a great question coming in here. When will details be available for this summer's in-person events for those who need to make travel plans? We haven't sent out official invitations at this point, but we do have dates and locations.
Yes.
And so those are set in stone. They are both near our offices. So that's, if you're making travel plans, that's the case. And we will send you an email to the person who sent this. We will send you an email with the details. We'll have official invitations coming out, but we do have dates and locations available. And I actually have them here, and I'm going to put them in the chat. So there's, hold on.
July 16th and August 6th, right? Is that right?
We have, yes, August 6th in Virginia at a place called the Grounds of Lviv in Oakton, Virginia, so very near the office. And then July 16th here in San Francisco at the University Club, which is, 6 blocks up the hill from our office. So let me just get this sent in the chat so everyone has that. Thank you to our background support for being so prepared with all the details.
Yes. And would love to see you there, as many of you who can make it.
Yes. Yeah, and so, we've teased them in past versions of the digest. These will be really focused on as always, social gathering and just getting to see everyone, but celebrating Dave and Elisa in this next chapter of their retirement. Who, by the way, in retirement are at a financial planning conference right now.
Were we supposed to share that? Is that a secret? Are we
I don't think it's a secret. They still have a big community and love staying in touch with everyone and abreast of what's happening in the profession.
Absolutely. Absolutely.
All right. Well, I think we are close to ready to wrap up. I want to give it another second just in case there are any additional questions. But thank you, everyone, so much for joining us today. It's been wonderful to, see all your names, imagine your faces in my head. And a recording of this webinar will be available shortly on our website. We've had some people who couldn't make it, who we already have on our list to send it to. If you'd like us to send you the link, feel free to email us, and we will post it on the website and have it in the upcoming digest tomorrow. Yes, today is Thursday. Tomorrow.
Yes. With that, thank you all for being here.
Thank you.